Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Lots of earnings coming out this week. We also had, in addition to the tech names, we also had a lot of big energy companies report. Exxon, Chevron reported. Let's break it all down with Vince Piazza. He's a senior equity research analyst covering the oil and gas space for Bloomberg Intelligence, joining us from Philadelphia via Zoom. So, Vince, let's break it down. Let's start with Exxon Mobil. Looks like they missed a little bit here on some of their earnings. Give us the lowdown from Exxon Mobil.
Well, look, I think here's the takeaway we're telling investors and listeners, right, that this is about cash. Cash is king. Yes, they missed. They telegraphed some of that miss. It's really on lower natural gas prices, margins, a lot of timing effects and maintenance issues, one-timers really. But if you think about ExxonMobil this quarter, I want you to say cash is king. Free cash flow of over $10 billion this quarter. That's a $40 billion run rate annualized. You know, they paid out something like $6.8 billion distributions, dividends, and also share buybacks. $33 billion of cash on the balance sheet at the end of Q1. This is the lowest financial leverage they've had in roughly a decade. So, yes, earnings did miss. That seems to be dragging it down roughly 4% this morning. But the main takeaway for us is that they're in a really strong position balance sheet wise. They're generating capital. They're paying dividend. It's a 3% yield, and they're buying back stock. The Pioneer acquisition, at least from what I heard, it doesn't really seem that there's much in the way that's going to push the closing of that deal past the first half. So once that deal closes, Paul, you're looking at a stock buyback run rate of roughly $20 billion a year. So I think they're in a fairly good position, probably better than this 4% clip that you're seeing this morning. And I think, quite frankly, better than what Chevron had to offer.
Yeah, break down Chevron for us. That company, adjusted EPS beat, upstream earnings beat, but the cash flow from operations for the first quarter, $6.8 billion versus estimates of $7.8 billion.
Yeah, so, again, cash is king, right? They posted GAAP free cash flow of just under $3 billion, yet they paid out $3 billion of divvies and another $3 billion in share repurchases. If you compare the financial leverage, right? Exxon is net debt to cap of roughly 3%, again, lowest in a decade. For Chevron, it's closer to 9%. So they're not generating the kind of free cash flow, and they're probably dipping in to the balance sheet to help fund those distributions. Obviously, there's also the uncertainty around preemption rights over Hess and really Guyana. So that remains an open question. Whereas Exxon's acquisition of Pioneer looks like it shouldn't be that many issues for them to close at that time, whereas the Hess deal for Chevron could get extended. So fewer questions around Exxon, yet it's down 4%. I have more questions around Chevron, and that seems to be roughly down 1%. But in terms of what's going on, what has gone on this year, I mean, Exxon, even with that 4% clip, it's up 17% this year, and it's pretty much in line with crude and what we've seen with crude do this year as well.
That's the one I wanted to get to, Vince. If you just update us, I mean, both of these companies are so diversified within the energy space. How highly correlated are they to the price of Brent crude?
Yeah, look, you know what? With the acquisitions that Exxon has made and what the acquisition that Exxon will make with Pioneer, they're going to be much more correlated to U.S. onshore, and in this case, Pioneer is much more exposed to the Permian Basin and much more exposed to regional Texas benchmarks. In the case of Chevron, with the Hess deal, they're going to have some U.S. exposure via the Bakken, but obviously the Guyana exposure in offshore. So that seems to be more tilted toward seaborne marks, whereas Exxon and the importance of the Permian for Exxon will likely shine through post the Pioneer deal.
We had Tesla earnings earlier this week. We talked a lot about dropping demand for electric vehicles. I'm wondering, to what extent is that bullish for companies like Exxon and Chevron?
So when we discuss natural gas, we've had a pretty rough winter, and storage actually ballooned. We're roughly 37% above the 5-year high for natural gas storage in the U.S., and that's a new 5-year average high. We have an oversupply issue, and we had a horrible winter, so we didn't see the cyclical demand. But in terms of natural gas's share in the more important sectors, the power stack, that has actually improved over the last several years. So nat gas as a feedstock into power generation, that will increase. It's not so much EVs, but think about the amount of power that one needs for all these data centers, whether you're mining Bitcoin or whether you're Microsoft and these other tech companies building out their data centers, you're still going to need a massive amount of power. And while you still are investing in solar and wind and other technologies, you're still going to need that transparency and the dependency on natural gas as a major feedstock into the power sector.
Hey, Vince, just wondering kind of where we are in terms of this commitment to going greener energy. I was at a BNEF conference with Alex Steele last week in New York, and a lot of the energy companies were there, and they're talking about the investments they're making and things like that. How do investors feel about the investments that these energy companies are making in their traditional fossil fuels versus maybe some of the newer technologies?
Yeah, I still think we're in the early stages. Exxon talked about direct air capture and gray versus green hydrogen. You're still going to need a significant amount of civic support, government support for these projects. Occidental seems to be more further along in terms of direct air capture. Exxon talked about that. Exxon continues to talk about it, but I think we're still somewhat a ways from using it as a mechanism in our models for a fundamental change in the makeup of these entities. It's still going to be about upstream extraction and cracking the molecules and putting them into the system, into the broader.
All right, Vince, thanks so much. Appreciate it. Vince Piazza, senior equity analyst covering the oil and gas space for Bloomberg Intelligence. There again, we had a couple of the big companies report earnings here: ExxonMobil and Chevron.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're a little lonely today. Friday's not a big in-person day.
Not a lot of people in the office.
But we're here in our Bloomberg Interactive Broker studio, but we are kind of lonely here. But I'll tell you, we're joined now by Sarah Ponczek. She's a financial advisor at UBS Private Wealth Management. She's based down in Boca Raton, Florida. Nice trade from New York City. She joined the mass of moving down to Florida. She was actually a little bit on the early side. Sarah, thanks so much for joining us here. A lot of earnings, a lot of economic data this week. We've seen some volatility in the equity markets, pulling back maybe 4 or 5% here off the peak. What are you telling your clients at UBS?
It's great to be here with you both. And yes, I was part of the mass exodus down to Florida, but I tell everyone that I was raised here. I'm from Florida. So
that's right.
I have a little bit of a leg up. But no, look, this was a big week in terms of information. When you think about what's driving the market right now and what is most important when it comes to thinking about the market outlook, There's really two components of that. One, inflation and growth, which we had insight into this week, and two, tech and tech earnings, because so much of this rally that we have seen over the past 5 months, past year, has been predicated upon this assumption that we are going to see unbelievable growth in AI. Now, with that said, what did we learn this week? Honestly, nothing too new. The PCE numbers this morning, they came in pretty much bang in line with expectations. Inflation's sticky. We all know that. The Fed's dealing with it, and they're just waiting at this point in time. And we saw some unbelievable tech earnings overnight as well, proving that CapEx spending in AI is paying off. So, as for what we saw this week, how that reflects into the outlook for the market ahead, there really isn't too much of a change at this point in time.
Okay, so when you look at the macro data, not just this week, but what we've seen over the last several months, are we really going to get cuts this year from the Federal Reserve, Sarah?
It's a good question. I think it's the million-dollar questions on everyone's mind. And frankly, I don't even know if Fed Chair Powell and his colleagues at the Fed know the answer to that question right now. Look, our economists' base case is that we will still see 2 Fed rate cuts this year. Coming into the year, our expectation was for 3. We never bought into the market's expectations that we might see 6, 7 rate cuts throughout 2024. We were standing pat at 3. That has since been revised to 2, with that starting likely in September, sometime in the back half of the year. But again, the only way that we are actually going to see that come to fruition is if we see progress on the inflation front. And right now, there are concerns and question marks surrounding that. So I would say, if we think about what's the biggest risk to our base case right now, what's our biggest risk to the market outlook? It is that inflation stays sticky for longer, and that those cuts just get pushed out into the future. And I know there has been some talk of even a rate hike at this point. That's not our forecast at this point in time, and we would there would be a lot that would have to happen. We would need to see a reacceleration in inflation for us to believe that that might be on the table.
So, Sarah, when you speak to your clients, kind of what are you telling them here as it relates to any change in maybe asset allocation, stocks, bonds, alternatives? What's kind of the message you're trying to get across to your clients?
So the message within the last couple of weeks, because it seems as though, investors always have short-term amnesia. You see any blip in the market, any volatility, and there's concern. So even amongst clients of ours who, have had phenomenal performance over the last year, after all, if you look at the S&P 500 over a 5-month span, we saw the stock market almost just go straight up 30% over 5 months. And all of a sudden, over the last couple of weeks, we are faced with volatility and we see a pullback. What are we telling them in relation to that? Well, one, we all have to know as investors, pullbacks are normal. Corrections are a healthy element of the investment process. In fact, if you actually look at how often we see 5% pullbacks in the stock market, on average, they happen about 3 times a year. So making sure that you don't see this pullback as a reason to completely throw your plan and strategic asset allocation out of place. Now, as you're asking a question as to what we're talking about, if we're making any changes as it pertains to asset allocation, I would say the biggest message to get across right now for a long-term investor who's trying to build wealth long-term is, if you are sitting on a lot of cash right now, which a lot of investors are, if you look at the amount of cash in money market funds, it's above $6 trillion. So there's a lot of cash out there. At this point in time, you should be looking to buy bonds, lock in yields, because yes, it's great that you can get a juicy 5.5% in a money market right now on your cash, but what are you going to be thinking? And I'm not even going to say a year from now, but 2, 3 years from now, if we see interest rates come back down and all of a sudden you didn't invest your cash, you're not getting a return on your cash. And by the way, at that point in time, you can't go out and buy bonds yielding what they're yielding now either. So making sure that if you're someone who's sitting on a hefty cash position, working through a plan and making sure that you're putting that cash to work, at least in the bond market at this point in time. For stocks, look, we're seeing volatility. It might make sense to ease into the market over a period of time. You don't need to do it all at once, but it's time in the market, not timing the market, that matters. And over a long period of time, cash is not the best asset class to be sitting on.
I'm wondering what you make of the boom in some of these options linked products. I write about ETFs, and earlier this week I wrote about a new ETF that offers 100% downside protection, but it caps the upside. We know that covered call ETFs have seen about $70 billion. Is that a product that people are interested in from your view, Sarah, or is it just an easier bet to just buy bonds? Don't worry about all this complicated stuff.
Well, it's a completely different, investment scenario. Investors who are looking to trade options, or, we do work with clients when it comes to structured products or structured notes as well occasionally. Investors like the idea of, being able to have their cake and eat it too. In essence, what you're describing is an investment product in which you can get upside but limit your downside as well. Well, investors, would take that any day of the week. Of course, there's always trade-offs, and I don't know the specifics of the ETF that you're speaking of, but I would imagine that there's got to be some trade-offs. You can't get 100% upside in the stock market and yet cap your downside 100% as well. But I would say from our perspective, more so I have had clients who might be sitting on, and I'm not going to name particular names, but maybe a large mega cap tech stock that has run up significantly over the last year. And we're talking about different option strategies with them on how to limit their downside, or how to maybe take some profits while being really smart and tactical about the tax implications of realizing those gains as well. How do you deal with the actual ramifications of having a position in your portfolio that has performed phenomenally? That's great. But at that point in time, if it is a significant portion of your portfolio, how can you diversify out of that position? How can you limit your downside, but while being cognizant of the tax effects as well?
Hey, Sarah, thanks so much for joining us. Always appreciate checking in with you. Sarah Ponczek, she's a financial advisor at UBS Private Wealth Management down there in lovely Boca Raton, Florida, going back to her home state there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Let's talk tech earnings. Lisa was just reporting on some of the tech names. Both Microsoft and Google reported numbers last night, beating expectations, putting up some pretty solid numbers. Both stocks trading quite well here this morning. Let's bring in Mandeep Singh and Anurag Rana. They are senior technology analysts for Bloomberg Intelligence. Mandeep is here in our Bloomberg Interactive Broker Studio, and Anurag is in Chicago. Anurag, let's start with you. Microsoft, what did you see from our good friends in Seattle last night?
Yeah, I was a bit surprised. I think the beat was much more than what I had anticipated. I was actually a little more pessimistic going in, but they really showed that they are the one software company that's really capitalizing on the AI demand. So I mean, all good on the Microsoft side. Margins are good. Outlook is good. So no bad news there.
All right, so Mandeep, let's likewise on Alphabet. I'm seeing the stock, 52-week high today, just ripping. You've liked this name. You've been on top of it all along. What were some of the takeaways from the quarter last night?
Yeah, this was one of our focus ideas because everyone thought their traditional search is getting disrupted. They're going to lose share in search. And what they showed us last night is not only, they have maintained their share, GenAI is actually helping engagement with their search. And not just search, on maps, on YouTube. And on top of that, I think what really should excite investors is they have got the cloud business where you see accelerating growth along with YouTube. So now it's a $100 billion ARR business going at 25% without any impact to the cost. Remember, everyone thought, the search queries are going to cost more because you have to use this GenAI infrastructure. No. There was a 500 basis point margin expansion in search. So clearly they have executed very well, and it's not a one-quarter thing. I think this is going to continue.
So Mandeep, the cloud operation for Google, first quarter profit of $900 million. That was ahead of estimate projections of $672 million. So can you talk a little bit more about what's fueling that beat in the cloud side for Google?
I mean, in the case of cloud, there is one traditional cloud revenue, and then there is the Gen AI linked cloud revenue. Mm-hmm. And what Google has done well is, one, they are getting the NVIDIA GPUs, and that's where, the 60% increase in CapEx is coming in. And the market didn't mind that CapEx increase in contrast to Meta, where the stock fell. So clearly they're deploying those GPUs on the cloud, and it's contributing in terms of additional revenue, which is where the beat comes from in terms of why that growth rate accelerated.
And Anurag, I'm just kind of looking at the, Microsoft, Satya Nadella, the CEO. He's been infusing Microsoft's entire product line with AI technology from partner OpenAI. How much of an advantage is partnering with OpenAI? How much advantage does that give Microsoft?
I think it is only in terms of time. So, before all the others catch up and try to do the same thing, I think it's a land grab thing at this point of, try to get as much as you can, get people hooked into these products with OpenAI. And then, but I'm fairly certain other companies, everybody from Google to Amazon will have a similar, infrastructure for other people to play with. They currently have it already. It's just that it's not getting infused in products that quickly.
What exactly are like Microsoft's AI services? What are some examples of how that company is basically deploying AI, especially for these enterprise customers?
Yeah, the first and the foremost is they run OpenAI's backend. So you use more ChatGPT, they make more money off of it. And that's the number one place we see the growth rate. Now we calculate that to somewhere around $1 billion a quarter at this point, run rate of all AI services added in for Microsoft. So that's a very big number, or annualized at 4 billion. The second part is a product called GitHub, where they have infused OpenAI services. So it helps people code things on a very much faster pace. Then you have Office 365 that also has co-pilots built in using OpenAI services. So I would say their entire suite, same thing for LinkedIn, same thing for, other products. So they are using a lot of those R&D dollars from, or R&D expertise from OpenAI to improve their own products.
Hey, Mandeep, I'm looking at our good friends at Google. This is an alphabet-free studio, as you know. So our good friends at Google, $80 billion of free cash flow this year, $90 billion next year. I'm a big, use of cash kind of guy. They're buying back $70 billion worth of stock, and they're going to initiate an actual dividend. That's a good thing, right?
Yeah.
Is that a good use of cash? I mean, it's not like they're skimping on CapEx or anything.
They're not, and probably they're following the Apple playbook, where all the free cash flow you generate, you use it for buybacks and dividend and CapEx increases. I mean, look, Google did raise their CapEx guide by almost 60-70%. So clearly, I think that's what investors want them to do, and they can't acquire any companies. So this is probably the best use of the cash, How do
you compare that with Meta? Because earlier in the week, it seemed like the Meta investors were not very happy about increased spending on, AI initiatives.
Well, I think Meta is one of the top 3 companies when it comes to generative AI, and they are exposed in a positive way. It's just they don't have a cloud business like Amazon, Microsoft, and Google have. So all the CapEx they do is going for their own infrastructure, for their own apps, which is very important. And it's helping them actually improve their ad targeting recommendation engines. But they also have a money-losing Reality Labs segment. And investors just want to discern how much are you continuing to lose on Reality Labs versus the AI CapEx, which is, I think, the good CapEx. So that's why you saw that stock reaction.
All right, Anurag, I'm looking ahead. That's what I do. Next Thursday after the close, Apple is going to report earnings. Their stock is down 11% year to date, really underperforming what it considers its peers, being the Metas, the Amazons, the Microsofts of the world here. What do you need to see next Thursday on that conference call after the close?
Yeah, any comments about stabilization in China is the only catalyst. Other than that, I mean, I don't see anything that can, I would say change the mood for what's happening with Apple, primarily because iPhone sales is what drives company. And there are no leading indicators that will give us any signs that can improve anytime soon.
Can I ask about Snap?
Oh,
Paul.
Mandeep's this.
I mean, I know we were talking about, the larger companies and the larger earnings, but I mean, Snapchat, this was the first time that we're seeing the stock higher. The prior 7 earnings reports, the stock just absolutely tanked after the earnings. So is this a turnaround for Snap?
I mean, look, for a company like Snap, which is not profitable, they are sort of driven by how the overall digital ad market is doing. And in this case, the print from Meta and Alphabet shows digital ad market is coming back. You're seeing a rebound, even though the small business sentiment is still quite weak. And if there's a TikTok ban, there is no doubt that Snap is one of the beneficiaries, both in terms of engagement as well as ad dollars moving to their platform. And we saw a glimpse of that in their print when they said their advertisers actually grew 85% and their brand ad revenue grew 12%, which is the first time in the last 4 quarters their brand ad actually is positive.
All right, Mandeep Singh, thank you so much. Mandeep Singh, Anurag Rana, they are senior technology analysts for Bloomberg Intelligence. They drive our global technology research effort at Bloomberg Intelligence. 2 of the best on the street. We appreciate getting them. Again, big numbers, good numbers out of the tech companies last night. Snap on the smaller cap side, 20 billion market cap. And then, of course, Microsoft and Google. And again, all those stocks higher. As we talked with Anurag, a big Thursday next week when Apple reports its earnings after the close. A lot of pressure, I think, on that company to, as Anurag said, kind of give some clarity about China. I'm not sure they can. There might just be one of those issues that's going to be hanging over this company for many quarters to come. I don't know. And then, of course, their play on AI. They do have a developer event on May 7th.
Right.
That's also going to be highly anticipated. Maybe that's an opportunity for Apple to come out and say, here is our AI strategy.
And a new iPad, right?
Yeah. I mean, I still have my iPad, the original one. I don't know. But I put everything on the phone these days. I rarely use the iPad. It's just everything's on the phone. But we'll see.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This market is moving higher. We had some PCE data today. The month-on-month at 0.3 kind of came in line with expectation, but the annualized number a tick higher. But again, strong tech earnings kind of driving this market here. Maybe a little bit of relief that the inflation data didn't come in even hotter, maybe 0.4% or 0.5% on a month-to-month basis here. Anna Rathbun joins us here, Chief Investment Officer at CBIZ Investment Advisory Services. Anna, thanks so much for joining us here. Boy, a busy week in terms of economic data, earnings data. Tie it all up together for us. And how has your market perception changed, if at all?
Good morning. My market perception hasn't really changed. We expected this week to be a very interesting and busy week. If you think about the market cap of the companies that are leading the S&P 500, those were the ones that were reporting this week. So it was going to move the markets up or down and definitely affect the beta of the market and the sentiment. And that's what we're seeing today. We saw that yesterday. I don't think it changes the general feel of the market's feeling like it's overbought. So I don't think it changes the dynamics. The PCE certainly could have had a bit bigger impact on the markets today, but it really didn't. So I think it's pretty much the same old, a little bit of a difference today with Alphabet.
Anna, do you think that the macro is getting maybe more confusing? Because like we were talking about, John Tucker was saying, the PCE data came in a little bit hotter, but we're seeing treasury yields down. Earlier this week, we had Bill Gross saying that he was bearish on tech, avoid tech. Now we have the NASDAQ up about 2%. What is going on? Is it getting harder for experts like you to kind of discern, what's really driving this market?
Well, so it's been hard for a while. So I don't think it has become hard. So in terms of PCE, frankly, it is hotter. The year-over number is a little bit hotter than expected, but it's actually in line with what the Fed has forecast back in March. By the end of this year, the Fed is expecting 2.6% in core PCE. We were year-over-year around 2.8, and that was a March figure, right? So we have a lot of room anything can happen between now and December. So I think we can be patient on that. I think the market's reflecting that. With regards to tech, I think tech right now, especially big tech, they're at a sweet spot between development of AI, and they're not betting the farm on it. They're just incubating it somewhere deep inside of their company while they're still while they're still able to churn cash, right? And so Google or Alphabet signaling a dividend, I think that's a signal. So I think that it's the sweet spot of AI and cash flow and quality earnings. I think tech still has some room to run, certainly notwithstanding the volatility that may come. But over the long run, I don't think it's necessarily a place to run away from.
So, Anna, we've had, I guess, about 45% of the S&P 500 report their earnings as of today. Any takeaways for you here? How's corporate America doing?
Well, the corporate America is not doing as well as the big tech companies might imply, right? So if you think about the three companies, Microsoft, Meta, and Alphabet, I mean, together they have returned year-over-year earnings growth of more than 60%. That is definitely skewing the earnings growth profile of the S&P 500 index in general. So, I mean, what do people say? S&P 495, or that would be 497, right? So I think that the rest of the markets, they're still lagging. I believe as of the end of last Friday, that was the last number I actually looked at for the entire index. If you're looking at 495 stocks outside of some tech stocks, we're looking at year-over-year earning growth that was a little bit on the negative side in terms of expectations. Hopefully, we will beat those expectations for the second half of the earnings season, but it's certainly not looking all that stellar.
When you look at the month of April, we have the S&P 500 SPY ETF down about 3%. We have TLT, which is an ETF that tracks long-term treasury bonds, down 6%. Where are you going for protection when it seems like that traditional stock bond correlation hasn't really been serving investors for protection?
Yeah, and that's been true for a while now, and it's been really tough for people who are 60-40, 50-50, you name it. I think you have to be actively protecting, especially with fixed income, which traditionally has been a hedge against equity beta. Lately, it hasn't been, right? Lately, meaning the last 2 years. That's a long time. I think you still have to be mindful of duration, because even if the Fed PCE came in relatively in line with expectations, and the markets are sort of thinking, okay, maybe the Fed can be on track. 3 rate cuts is still a bit high, in my opinion. They may be doing 2, maybe down to 1, depending how the data runs between now and the end of the year. So I think duration, you still have to be a bit careful. But look, the total yield profile is very delicious. It's yummy. So I think clipping coupons and being aware of duration is what you have to do with your fixed income portfolio.
So, I mean, that's a great point. I want to just get on the fixed income story here. Do I sit in my 2-year treasury at close to 5%, or do I take some credit risk here?
So high yield, I mean, when I think of lower duration profile than your traditional fixed income benchmark, which is the AG, and then of course clipping high coupons, I think of high yield, right? High yield is sitting at duration a little bit less than 4 years, and I think the last time I checked, the total yield for the Bloomberg High Yield Index is around just under 8%, nearly 8%. I mean, that's a really, if you think about yield versus duration risk, that's actually not a bad risk-reward ratio. And frankly, high yield, if you stay in the higher credit profile, it's not a bad deal, right? So rate hikes, I'm not saying that, everything, it's the tide that lifts all boats, not like that at all. If you want to utilize active managers to really look for quality balance sheet, I think that could also work as well. But that yield can actually, if there is a spread widening, can go a long way to protecting on the downside in terms of price action.
All right, Anna, thank you so much for joining us as always. Anna Rathbun, she is the Chief Investment Officer at CBIZ Investment Advisory Services, joining us from Cleveland, Ohio via that Zoom thing.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Eric Kazatsky joins us here. He's the senior municipal bond strategist for Bloomberg Intelligence. Hey, Eric, talk to us here. We've had rates kind of moving around here. We had some higher rates earlier. Talk to us about what's happening in the municipal bond market vis-a-vis kind of the treasury market here.
Yeah, absolutely. Well, there's two ways you can really look at it, right? We can focus on total returns, which certainly aren't that great, or you could look at it as a buying opportunity, right? Yields are up 30 basis points on the month, about 55, 60 basis points on the year. Certainly not near where we were last fall, but certainly an interesting opportunity to come back into the market and, get those 4%, 5% higher premium structures at cheaper dollar prices. And that's ultimately what people want to be doing when they're building portfolios.
If you run ETF Go on the terminal, I'm bringing ETFs into this, Paul.
Yeah, let's do it.
You can see that over the last year, when you scan for municipal bond ETFs, $16 billion of inflows into those funds. Does that make sense to you that we're seeing this much money kind of pour into this strategy right now?
Yeah, absolutely. Right. So anytime you have a cheap beta strategy that has gotten a lot of attention in the news, not only what we're saying on the Bloomberg side, but externally, there's going to be more attention focused on that from wealth advisors and retail clients. And that's why you're seeing those flows go in there. But just to kind of keep it in context, from a notional standpoint, 16 billion flows in a $4 trillion market, it's not really that big of a deal. It seems impactful sort of looking at it in a vacuum, but when you look at a total muni market, still a very small piece.
Hey, Eric, I want to ask you about this Brightline deal, this railroad deal.
Yeah.
Talk to us about, I know they came to market recently. What is Brightline and what was the deal they brought to market?
Yeah, so obviously they have a train system down in Florida. Right now it's going from, Palm Beach area down to Miami. They're extending it up to Orlando. It's a high yield deal. There was two portions of the deal. One was triple B. There was a non-rated portion. Part of it was a refunding. Look, it's still a speculative project. Will people use the train? What will ridership be? A lot of questions that nobody really seems to have answers for. But I will say, look, I'm definitely jealous. I wasn't able to get any of those bonds, right? If you look at sort of where they came on the non-rated portion, you're talking about 12% tax-exempt yields. On a tax equivalent yield basis, it's like 18%, right? So obviously a lot of risk and a lot of compensation being demanded for the risk being taken.
And how was that deal welcomed by the marketplace in terms of demand?
Very oversubscribed. And that really sort of speaks to the dearth of high yield issuance that we're seeing in the marketplace and also the returns that we're seeing in high yield munis as well. So we started off the conversation talking about IG total returns, which are down almost like 2% on the year. But high yield munis are positive, right? They're really the only green portion of the screen I can look at when I look at IN Go and looking for munis. So there is obviously a lot of interest, both retail and institutional, in high yield credit and looking for deals that have some hair to them.
You have a note out. It says, muni tourists who dabble casually in the municipal bond market are being bombarded with calls to come back to what has been a treacherous place so far in 2024. What kind of market outlook does an investor have to have if there's someone who was a muni tourist and now they're going to come back into this space?
I think a lot of people got scared last year because they found out that their bond portfolios could have losses. And I think that's something a lot of investors probably hadn't seen before. So there was probably some reticence there. And then there's a lot of excitement as last year ended where rates were rallying, right? And munis turned out to be a great buy. They're still a great buy from a risk-adjusted, purchase standpoint, because they have much lower default risk than corporate credits. But, there is probably a reticence to sort of dive back in, knowing that the Fed really doesn't have a firm control on where inflation is right now and when and if they're going to cut. But like I said to Paul, if you can come in and you can buy those 5% coupons at a lower dollar price, I think it's a more interesting opportunity right now.
So, Eric, what's the credit risk profile of the municipal bond space? I know historically it's generally been pretty darn good. Are we seeing any cracks out there?
No, not as of yet. I mean, if you look at just the Bloomberg Muni Index, it's average AA credit quality. And that really sort of spans the gamut. You have some triple B rated credits in there and some AAA rated credits, right? Just the average is AA. I will say that from a rating agency standpoint, we're not really seeing any cracks, but they're also very backwards looking in that they're looking at audits from last year. Everything's on a very big lag. We're actually working on a new sentiment monitor over on our side on BI. And what we're showing, so on a predictive standpoint, is that things should be worsening or at least softening a little bit when it comes to municipal credit in the next 12 to 24 months, right? We've seen a very large uptick in headlines talking about layoffs in the state and local government sector, as well as budget cuts and budget deficits. So something we want to keep our eye on.
How should investors be thinking about picking where in the market they want to invest? I'm going to bring this back to ETFs, but obviously you can buy a muni ETF that's going to track a number of different regions of a specific, state in the U.S. Is that the better bet, or should people be kind of maybe zeroing in on a specific state right now?
Well, I think it goes back to the argument of passive versus active management. And I think in a sloppier market like we're seeing now, when yields are higher and there's a lot more volatility, the case for active management can really be made. You talk about those ETFs that are getting the flows, they're passive structures. So if you look at what they're actually investing in, they're missing about 30% of the muni market by credit exposure. They're not buying higher education, they're not buying hospitals, they're not buying natural gas bonds or bonds subject to AMT. So all of sort of the higher alpha areas that we've seen over the last several months, they're missing out on. So that is an opportunity that you would find more on the active sector, but you're going to be paying more for a management fee for that. So if it was me, I'd probably be looking more toward active management right now in this market.
All right, Eric, thanks so much for joining us. Eric Kazatsky, Senior Municipal Strategist for Bloomberg Intelligence, joining us from the Princeton, New Jersey offices of BI in Princeton.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.